This was driven by both food and non-food prices. The divergence between WPI and CPI inflation was on account of differences in the composition and weights of commodities in the two indices, as well as different rates of price increases for similar commodities represented in both indices. In the April policy, the Reserve Bank made a baseline projection of WPI inflation for March 2013 of 6.5%. However, since then, several upside risks have emerged. First, the monsoon has been deficient and uneven so far. This will have an adverse impact on food inflation. Second, notwithstanding some moderation, international crude prices remain elevated. On top of that, the rupee depreciation had added to import prices, putting upward pressure on domestic fuel prices. Third, the adjustment of domestic prices of petroleum products to international price changes is still incomplete. Going forward, the embedded risks of suppressed inflation could also impact fuel prices in India. Fourth, non-food manufactured products inflation has not declined, in line with the slowdown in growth. And finally, input price pressures on account of the exchange rate movement and infrastructure bottlenecks in coal, minerals and power may exert upward pressure on non-food manufactured products inflation. Keeping in view the recent trends in food inflation, trends in global commodity prices, and the likely demand scenario, the baseline projection for WPI inflation for March 2013 is now raised from our April projection of 6.5% to 7%. Let me now turn to liquidity conditions, which have eased considerably since the April policy. This turnaround was due to a decline in government cash balances with the Reserve Bank, injection of liquidity of about 860 billion rupees by way of open market operations, and increased use of export credit refinance facility by banks after the increase in limit effected in the June mid-quarter review. Our projections of growth and inflation for the current year are subject to a number of risks. First, external risks to the outlook for the Indian economy are intensifying. Adverse feedback loops between sovereign and financial market stress in the euro area are resulting in increased risk aversion, financial market volatility, and perverse movements in capital flows. With the deteriorating macroeconomic situation in the euro area, interacting with the loss of growth momentum in the US and in emerging and developing economies, the risk of potentially large negative spillovers has increased. India's growth prospects too will be hurt by this. Second, reflecting the setbacks to the global recovery, as also weather-related adversities in several parts of the world, the outlook for food and commodity prices, especially of crude oil, has turned uncertain. These developments have adverse implications for domestic growth and inflation. Third, inflation in protein items remains elevated due to structural demand-supply imbalances. On top of that, there will be further pressure on food inflation because of the deficient and uneven monsoon, thus potentially aggravating inflation and inflation expectations. And finally, at the current levels of current account and fiscal deficits, the Indian economy faces the twin deficit risk. Financing the fiscal deficit from domestic savings crowds out private investment, thus lowering growth prospects. This in turn deters capital inflows, making it more difficult to finance the current account deficit. Failure to narrow the twin deficits with appropriate policy actions will threaten both macroeconomic stability and growth sustainability. Let me now conclude by summarizing our macroeconomic concerns. While growth has slowed down significantly, inflation remains well above the comfort zone of the Reserve Bank. Against the backdrop of heightened global uncertainty and domestic macroeconomic pressures, The challenge for monetary policy is to maintain its commitment to firmly containing inflation, lowering inflation expectations. At the same time, monetary policy will remain sensitive to growth risks. Finally, I also want to reiterate that the Reserve Bank stands ready to respond to external shocks that may stem from the turbulent global situation. Thank you for your attention. Thank you.